Every dollar in your wallet is actually debt. Not metaphorically, literally. Each Federal Reserve note represents a liability on the central bank's balance sheet. And the system behind it? It's engineered to ensure the national debt can never be fully repaid. The question isn't if you should be concerned, it's why this was designed this way in the first place. Welcome to the Wealth Timeline, where we uncover how money, power, and history intertwine to shape the world we live in. Before 1913, America's financial system was chaos. Bank panics erupted every decade. In 1907, J.P. Morgan himself had to personally orchestrate a bailout of the entire banking system from his library on Madison Avenue. The message was clear. The country needed a lender of last resort. Enter the Federal Reserve Act, signed into law by President Woodrow Wilson on December 23, 1913. Sold to the public as a safeguard against financial panics, the Federal Reserve was structured as something unprecedented. A hybrid entity, part government institution, part private banking network. 12 regional Federal Reserve banks, technically owned by private member banks. A board of governors, appointed by the president. The mandate? Stabilize the currency, maximize employment, and act as the government's banker. But here's the detail that changes everything. The Federal Reserve was granted the authority to purchase government securities, essentially, to buy the government's debt. At the time, this seemed reasonable. The government could borrow when needed. The Fed could manage the money supply. Two separate functions working in harmony, except they weren't separate at all. Because when the Fed buys Treasury bonds, it doesn't use tax revenue or savings. It creates new money electronically and uses that newly created money to purchase government debt. Then it holds that debt on its balance sheet, collecting interest payments funded by taxpayers. The implications? They wouldn't fully reveal themselves for decades. For the first 20 years, the Federal Reserve's role was relatively contained. In 1920, the national debt stood at $24 billion, roughly 30% of GDP, mostly from World War I financing. Then came the Great Depression. Then World War II. By 1945, national debt had exploded to $260 billion, 119% of GDP. The Treasury needed unprecedented amounts of borrowing to fund the war effort, and the Federal Reserve became the willing partner, purchasing massive quantities of government bonds to keep interest rates artificially low. This was the beginning of debt monetization, the process where a central bank finances government spending by purchasing its debt. The post-war consensus was clear. The Fed would support Treasury borrowing. Interest rates on government bonds were capped at 2.5%. The marriage between monetary and fiscal policy was complete. But in 1951, something shifted. The Treasury Federal Reserve Accord. Under pressure from Fed Chairman Mariner Eccles, the central bank won its independence, the right to set interest rates without Treasury interference. The Fed could still buy government debt, but only for monetary policy purposes, not to directly finance government spending. Or so the theory went. Through the 1950s and 60s, the relationship remained stable. National debt grew modestly. The Fed maintained its distance. Then came the 1970s. Stagflation, oil shocks, Vietnam War deficits. The national debt crossed $900 billion by 1980. The Fed, under Chairman Paul Volcker, raised interest rates to nearly 20% to crush inflation, making government borrowing extraordinarily expensive. The lesson was brutal. When the Fed tightens, the government's debt burden becomes unsustainable. By 2008, national debt stood at $10 trillion. Then the financial crisis hit, and the Federal Reserve crossed a line it had never crossed before. November 25, 2008. The Federal Reserve announced it would purchase $600 billion in mortgage-backed securities and government debt. They called it quantitative easing. The mechanism was simple but revolutionary. The Fed would create trillions of dollars in new reserves and use them to purchase Treasury bonds and other assets from banks. Not temporarily, not as an emergency loan, as permanent additions to its balance sheet. Before the crisis, the Fed's balance sheet totaled $870 billion. By 2014, after 3 rounds of QE, it had ballooned to $4.5 trillion. The Federal Reserve had become the largest single holder of US government debt. larger than China, larger than Japan, larger than all foreign creditors combined. But here's where the story gets strange. When the Fed buys Treasury bonds, the Treasury still pays interest on that debt. In 2022, the Fed collected over $170 billion in interest from the government. But because the Fed is required to remit its profits back to the Treasury after operating expenses, most of that interest, roughly $76 billion that year, was sent back. The government was essentially paying interest to itself. This created a perverse incentive. The more debt the Fed bought, the less the true cost of government borrowing appeared. Politicians could spend without immediate consequences. Deficits could explode without triggering market discipline. From 2008 to 2020, national debt doubled from $10 trillion to $20 trillion. Then the pandemic hit. Another $7 trillion in 2 years. The Fed's balance sheet, it expanded to $8.9 trillion by April 2022, holding over $5.7 trillion in Treasury securities. But the breaking point wasn't the quantity of debt. It was what happened next. In March 2022, the Fed began raising interest rates to combat inflation. And for the first time in its history, the Federal Reserve started losing money, because the interest it paid on bank reserves exceeded the interest it collected on the bonds it held. In 2023, the Fed's losses exceeded $114 billion. In 2024, another $80 billion in losses. No remittances to the Treasury, no profit sharing, just losses, recorded as a deferred asset on the balance sheet. An accounting fiction that let the Fed continue operating. The system had broken, quietly, technically. Today, US national debt stands at approximately $36 trillion, 123% of GDP, higher than at any point except the immediate aftermath of World War II. The Federal Reserve holds roughly $4.8 trillion of that debt, down from its 2022 peak as it slowly reduces its balance sheet through quantitative tightening. Here's the reality. The Fed's dual mandate, price stability and maximum employment, is now inseparable from its role as the government's lender. When the Fed raises rates to fight inflation, it makes government borrowing more expensive, threatening fiscal sustainability. When it lowers rates or buys bonds, it enables deficit spending but risks currency debasement, and the rest of the world is watching. In 2023, foreign holdings of US Treasuries declined for the first time in over a decade. China reduced its holdings from $1.3 trillion in 2013 to under $800 billion today. Central banks in Asia, the Middle East, and Europe are diversifying into gold, other currencies, and digital assets. The unspoken fear that the Federal Reserve's credibility, the belief that it will act independently and prioritize currency stability, has been permanently compromised by its entanglement with fiscal policy. Because once markets believe the Fed exists to finance government deficits, the entire architecture collapses. So what have we learned? First, the Federal Reserve's relationship with national debt was never designed to be permanent. It evolved through crises, each emergency expanding the boundaries of what was acceptable until the exceptional became normal. Second, debt monetization, once considered a violation of central banking principles, is now standard practice. The difference between financing deficits and conducting monetary policy has become a distinction without a difference. Third, the system contains an internal contradiction. The Fed cannot simultaneously maintain price stability and enable unlimited government borrowing. At some point, the choice becomes explicit. The question isn't whether this system is sustainable. History answers that clearly. The question is what comes next, and whether the transition will be managed or catastrophic. Because in the timeline of wealth, every rise comes with a hidden cost, and the bill for a century of monetary expansion, it's coming due. If you enjoyed uncovering this hidden story, make sure to like this video, subscribe to the Wealth Timeline, and turn on the bell icon. Because history's next secret is already unfolding.